Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Let's talk about that then. So let's through the process, your investment process, and I guess your client process, if you will, we've moved from sorting out their financial affairs, that side of things. Now we've moved through strategic allocation, which might be based on risk profile, appetite, time horizon, all those different wonderful things that we talk about in financial planning. But then the next step is choosing the right manager for that portfolio. So how do you go about doing that? And how do you go about, what are some of the, I guess, just from a high level, some of the things that you think about before you make a decision to add a manager?
So I've got, as you expect, we've got extensive questionnaires and information. There's a good tool, some managers release it, which is, I think it's called the Financial Services Questionnaire.
Yeah, right. I've never heard that.
If they want to be, I think if they want to be approved as a manager, it's a 50-page questionnaire. They have to detail their investment philosophy.
Oh, right. I have seen it actually. Yeah.
It's more the compliance document, which is actually, when they have to be succinct, you get rid of all the fluff and the PowerPoint slides that come with it. We probably have 20 criteria, but I think we've kind of not dumbed it down, kind of shrunk it down to 5 because we could talk for another 6 hours otherwise.
Yeah.
Ultimately, you're looking for after fee returns that are beating the benchmark. That's what we're all looking for.
Yeah.
And we say after fees because there's always a question about, is an active manager another whole discussion. 70% of active managers outperform. I also question that statistic, the generalization. But you take fees out of the equation by assessing performance after fees against benchmarks. And yes, performance is, past performance, no guarantee of future performance, but it's a pretty good indicator that someone, particularly in this environment, has dealt with a crisis. How they've dealt with crises, have they outperformed during those periods is incredibly important.
How do you think about, speaking of fees, how do you think about performance fees? There are two camps on this. There's one camp that says there should never be a performance fee because it means you're paying them to do their job, you're paying them more to do their job. But then there's the other camp that says, well, we should be incentivizing them to do better because that's a good outcome for us. Where do you see that?
I'm on the more performance fees, the better. The more it's expanded, the better. As long as that is reducing the base fee.
Yeah.
I think it's where the institutional world's going, where your base fee gets lower and lower, but you're being paid a performance fee. But for us, that performance fee has to be based on not just benchmark outperformance, but absolute returns. There's no point. Why should you get paid for falling 20%? If the market fell 30, you still lost 20% of that capital.
Yeah.
That's not our performance. So making sure they're adjusted appropriately. And most funds are now offering a full fee. So I think Platinum was one example where it's 1.3 or a lower fee plus performance. And that kind of comes to alignment, which we see as important when picking a manager. So is the other decision makers investing in the fund? You always want to make sure that their wealth is invested in a substantial amount, particularly in some cases, and their bonuses and their performance targets are going back into the fund, not just yours.
Yeah. So do you just ask them that?
Yeah, most will be very open. If they're not open, then generally they're not investing it in there.
Yeah.
When it's a startup manager, then it's more likely that they are putting everything in there, if they're not attached to a big institution. So with institutions, you just want to make sure that there's still alignment.
So how about then again on a performance fee? I'm guessing you're looking for high watermarks. So performance has to return to the level that it was previously. How about then managers who benchmark against fixed benchmarks. So say like I don't know, like a 5%
Cash
hurdle or
plus.
10% hurdle or something, or cash plus. Yeah, something like cash plus. What do you think about those?
I think they're all right in certain situations.
So would you be comfortable if an equity manager, for example, had a 8% fixed fee absolute return?
Ultimately, I prefer if it was almost a benchmark plus, but then, it's kind of, you don't want to pull all of their fees away from their business if they can't make a decision. For instance, if you're a long only equity and you can't move your cash greater than 10%, well, there's only so much you can do in terms of protecting your portfolio. So it's being wary of that part as well.
How about then, say, like absolute return funds that are like RBA cash rate kind of thing? What do you think about those?
Plus a bit more is what I prefer.
That's always something that struck me as kind of unusual, is that yes, you're an absolute return, but you do invest in risk on assets, so you should have
a real hurdle.
We see this more often, that people say, oh, the management fee is pretty low. However, we take a performance fee, but the management fee being low doesn't really mean much if the benchmark for the performance fee is also so low.
Yeah.
Because then it's just put it in a cash plus fund or like a cash enhanced fund, and you probably make a performance fee.
And they've got their own pressures as well. So a lot of the institutional investors that go into these funds will get different fee arrangements to what we and direct investors get, where it's more performance, where they want it as low as possible and they don't get the base fee. So it's kind of, it's always, you got to be shrewd. And
you bring up a good point there, Drew, which is sometimes, and I know that, like, for example, like you guys might be able to do this too, is when a fundie comes to you and says, hey, this is our fund, come on, we can do this for your clients, and blah, blah, blah. Do you have bargaining power with them?
Sometimes. Yeah. So we can, in quite a few occasions, we've negotiated discounts to management fees. I won't say which ones.
But it's
only clients will know that. Obviously, they don't want other people to know either. And I mean, it's actually more work for us, because when your fees are rebated in the form of extra units in the fund, we have to enter that onto our system every month. So it's actually a lot of an administrative burden, but there is some negotiating power, definitely.
Yeah, and because you hear this, right? I heard some extreme examples this week of some I won't name names, but investment managers who have been approached by big pension funds to say, we'll give you $1 billion to manage, but it's going to be 1 basis point. That's an extreme example, but it does happen quite a bit. And for retail investors, they don't often understand that, because they don't have the leverage. They can't say, I've got 50 grand, what can you do for me? Mr. Manager with, $2 billion under management. So it's a totally different, I guess, bargaining position.
Particularly with newer managers as well. But obviously the more assets you have, the better. I'm writing an article on probably the same fund manager you're talking about at the moment.
So how about then, there's one thing that I learned from you recently when we were just talking offhand, which was this idea that when you rebalance, the actual when is really important. So it's not just about, this is strategic asset allocation, equities have hit this part of this much in the portfolio, let's rebalance. It's actually when you make that decision is actually crucial. And March, I think, was a really good example of that. So maybe can you talk us through like when is the best time to make strategic changes or tactical changes?
The best time is the hardest time, and that's probably where our value has been shown best in the last few years, is that when markets are crashing or running, is actually the best time to rebalance. It's been the most powerful. Right. It's a very nervous period. I was waking up and seeing the S&P had fallen 7% overnight, and then working out what I was going to do that day. But if you can rebalance, so for instance, I bought 2 examples, or I have 2 examples from March, April, that we did. One during March, so we went outside of our quarterly period and said we should do this, and then in April as part of our quarterly period. So we did 2 stages. We saw that equity markets had fallen 25%, so our equity exposure was very low. We have a large, reasonable allocation to alternative assets, another discussion there, that held their value or went up. So we made a decision that we needed to increase our equity exposure, and there's other inputs into that, not necessarily a vaccine, but that the market sell-off was completely overdone to what was actually occurring.
Totally.
So we moved 5% of the portfolios from alternative assets into equities, very close to the bottom of the market. And that, as we said before, if you were selling equities, you just capitalized a 30% loss in 4 weeks. If you were buying equities, well, you've just picked up a 40% gain in 6 weeks. So it's as difficult as it is. The quarterly period helps. We try not to be stuck on the quarterly. We're still doing investment committee and reviewing asset allocation at least monthly, and stocks almost daily. But just having structure and being willing to make a major decision during difficult periods, and that's where the objectivity of me managing someone else's money versus managing your own money makes it a bit easier. The amount of positive feedback we got from clients that said, I'm happy you've been trying to protect our portfolio during this period. This is great advice. I wouldn't be doing it. Couldn't stomach doing it myself. Just kind of being a step back, even though my parents are one of my clients as well. So there's, yeah.
How about then, so let's say you're not someone who's advised. What are some of the things that people could do, I guess, just to think that way and try and move themselves towards that? Do you think having the structure of quarterly rebalancing is essential for everyone, regardless of whether you're an advisor or not?
I think you should at least be doing it every 6 months. Set an hour apart, download some asset allocation reports. There's a lot you can get. Morningstar, as we said, is one example that has a personal investor product as well. We think the first thing we do for every new client is we build an investment policy document which sets out asset allocation, rebalancing, when we buy and sell. If equities are 5% below the target, then we want to increase them, and kind of those rules.
Yep.
And then we give every client that on a single page, which I think everyone can easily do. You can Google, I think Vanguard has one as well. You Google investment policy document, pension funds run with them, corporate super funds run with them. That's just a simple thing. If you died tomorrow, someone could pick up your portfolio and hopefully understand what you're doing.
Yeah.
And then just having some structure.
And that's a big thing, you're a certified financial planner, right?
Yep.
Yeah, CFP. And you see that in the CFA programs as well. It's such an important part of the process. People kind of write it off because it's not always the most technical, but it's actually probably one of the most important parts of just your own investment process as well, right?
It should be the first thing. So every trustee board of a super fund would pull out their investment policy at every board meeting, and that's what they refer to. And if you think it needs to change, you change your policy, and then you change your investments feeding into it. And it's just discipline. Maybe I'm just one of those kind of regimented people where I like structure, discipline, consistency. And I think you need that for investing.
I think in the US, particularly, we're seeing more of this is the robo-advice market, servicing that lower end of the market. They're starting to do this more often. So they have an investment policy statement, but then they also have kind of like feedback loops for the user, as opposed to a user in that product or in that service to question their decisions. Like, don't click this button unless you've checked this.
Yeah.
And that's kind of a low-cost way to fill that need. But I think everyone can do this to an extent, right? But if you do find yourself getting a bit tangled up in everything, go and see someone. Let's get back on the topic of fund managers. What are some of the questions you would ask a fund manager? Do you have any kind of examples that you can give us from your, you mentioned before you have quite a few, but are there any examples that come to mind?
I'll probably go examples on what they've been doing. So we talked about attribution. One of the best ideas there is the active share. I'm sure you know that stat.
Maybe you can explain it for
measure.
us, just for those people that don't understand it.
Yeah, so active share is a percentage, and basically the percentage of stocks that company or that fund manager holds that are different from its underlying index. So if it's a US large cap strategy and it's active share is 95%, that means 95% of the stocks are different to what's in the S&P 500. So if we're making the decision to employ an active manager, well, we don't want to pay active fees for someone that's doing an index, giving us an index. So if you've got a low active share, honestly, then you may as well buy the ETF in that case. And part of that active share talks about attribution. So where are the returns for that fund coming from? Are they doing what they're saying? Is, are they a value manager? All right, is a value manager holding tech stocks? There's kind of this overlap that all the factors, we can talk about that too, fall into are kind of falling into the same funds. There's a lot of value managers that are holding growth stocks, and there's a lot of growth managers holding value stocks. So asking the questions that and confirming where the performance of that fund is coming from. Is it coming from what they're actually saying?
This is the thing though, right? Like a lot of DIY investors, they don't have access to attribution. So attribution is something that we use a lot in advice land, but also in research land. We talk about, so yeah, it's good. You can see the top 10 holdings in a monthly or whatever. But attribution, for those people who don't understand it, it actually looks through the portfolio. So I think there are certain financial providers and data providers that say that, we provide this look through and we'll give it a fancy name and whatever.
Yeah.
How do you get that attribution on returns?
We've got our own systems. We've got a couple of systems. One's Xplan, Iris, the biggest tech company in Australia, which does a portion. And then we use a couple of research providers. And then interestingly, most managers who use the same software as us will input our portfolio and compare their strategy they like us to invest into, and give us the attribution. So it talks about how many basis points did this individual stock holding add to performance over a period, how many detracted, and you quickly see if 40% of the returns are coming from 4 stocks. It's a lot of look through from a simple report.
Yeah, and this is something that is really interesting because, to be honest with you, Drew, like I know from a financial planning perspective that growth versus value is a conscious choice that advisors make. From a personal investor perspective, I'm kind of like looking for absolute returns, and I know there are certain times when value is better than growth and what have you. But when it comes to attribution, you can also do factor analysis based on what they send you. You can look at geographies. If they're a global fund, where are they getting their most of their alpha? If they're if you compare it to the factor models, are they using small caps? Are they using low PE stocks? Yeah, that's really insightful, right?
Yeah, they're actually really easy for us to get. Everyone is willing to give them to us, and we're able to analyze them ourselves as well, which you don't get factor in a monthly report or a quarterly report. You get a couple of stock highlights and what the top 10 stocks are. But there's so many tools. You can almost paralysis by analysis can be an issue sometimes. But you just understanding, are they doing what they're saying? And that a big part of that is a question of, if they underperformed in the past, have they changed their approach? Is a growth manager that underperformed now becoming a value manager because value is doing better? These are the kind of reasons you'd remove or you'd watch for in a manager that you're employing.
Yeah, we see that. You see that style drift quite often.
Yeah,
I don't mind it when a manager is explicit about it. Like, hey, we've invested this way for a long time, but we think this is a structural shift. I'm going to be honest with you. This is what we're doing.
Yeah.
But it's when they don't say anything and they've all of a sudden gone from owning,
no tech to all tech.
Yeah, no tech, all tech. Yeah, something like that. And they're not being honest with you. That's where I get a bit frustrated, and I'd be more inclined to question that. How about then when it comes to the resourcing of a fund manager? So a lot of people probably don't think about this, but I know you guys do. You think about it a lot, which is, a lot of these smaller boutique funds, they can be one-man bands or two-man bands or two people bands. We shouldn't be, it's not all men these days. So it's sometimes you have very small shops, so to speak. So how do you think about that, the resourcing angle?
Yeah, I mean, it's a difficult question because you do get great returns, and some of our best performances come from startup managers. I think there is a bit of almost flooding in the market. You have to understand that for most managers, I think you need something like 150 million under management to be cash flow break even. And not that there's anything bad if a fund manager shuts. This is the other benefit of a managed fund over a listed investment company. If they aren't cash flow break even and they shut down, well, you can get your money back because it's just invested into stocks. If that was potentially an LIC and the manager shut down and someone else took over, then you might be selling at a discount. Probably one of the differences there. But you just have to ask all kinds of questions. How funded are they? What are their expenses? And a big part of that is, do they have if you're a global equity manager based in Australia, do you have the resources if you're not making money to outperform Magellan? Not pushing Magellan or anything. It's all, there's the businesses too. They get into it because they want to be more aligned with their investors. So what level of assets do they need to be break even? What level of assets do they need to add new analysts? Because it's great to have one investment decision maker, but as we all know, you don't want to be reliant on a single person. The big groups have done it well, bringing younger people up and spreading the decision making in different portfolios. And one of the issues there is, will they spend more time selling their product than they will analyzing? Yeah, that's the biggest risk in the early days. I think you have some comfort around when someone's got an extensive background and track record in that specific strategy, that they will keep, that they know it, and particularly if their ex-employer has kind of signed off on what they've done.
It's one of those things, right? Most new funds, unless they do come out of a big shop and they have the support of a distribution partner, which we see probably more of these days.
Yeah,
it's more the distribution. The person that controls the distribution goes and has control and goes to Macquarie or goes to one of these big shops and says, "Hey, you guys look like you're good investors. Why don't you come over here? We'll give you a fund. We'll take an equity stake, and or we'll do all the distribution for you. No worries." Unless you're like that, the other side is the boutique fund who tries to guide it by themselves, and they tend to keep their head in the sand for a while until they've got that track record, because they know no one's probably going to look at it.
Yeah, and it's kind of the fiduciary obligation that a financial advisor has as well. We're probably more comfortable backing a new manager that's associated with a $500 billion, fund manager, because they've got the resources. They've got, if you're doing global equities, you've got access to all the research from all the biggest players. So you do have some sort of competitive advantage. Yep. So it's resourcing like any business.
And then I guess you also, just on that, you also want to meet with people, right? Like it's just like anything. You got to know what you're invested in. So I imagine that you don't invest with someone unless you speak to them. Is that fair?
Yeah, we got 3 rules. I think it's 3. I mean, there's multiple. 3 rules. We have to have access, so we have to be able to meet the PM, the portfolio manager. Yep. No offense, not the juniors. They might make all the decisions, but we want to meet the portfolio manager. We want to see the real portfolio, all the holdings. Yep. Usually that's non-disclosure or confidentiality, and all those sort of things. And kind of standard is fees, making sure the fees are competitive as well.
Yeah. How about then, just kind of like, I know this conversation has gone on forever and we'll probably come back to it many, many times, but then what about like kind of this last piece, which is around risk management? So it's funny because when you get these, when you get these research documents and these policy documents, oftentimes the risk management is just a couple of paragraphs. How do you think about risk management, and how do you judge a fund manager's ability to protect capital? Tough question.
Yeah. I mean, it depends on the strategy. So a long short manager versus a long only, which means one can take short positions and kind of hopefully protect the portfolio by doing that. You have to assess them differently. If it's long short, do they use their short positions prior to crises? And good ones have. And you can see the performance for some of them. The other ones are one, do they have rules in place? So you have to ask them things like, do you apply stop losses? Can you increase your cash balance? What specific rules do you have? How big can your biggest holding be? What are your sector exposures? Because you can, control your downside by not being overweight. For instance, the banking sector in Australia that's down 30% and represents 30% of the index. So you can outperform and you can not lose capital by having sector weightings. And do they actually stick to them? So when you see the portfolio and they say that they only have 2 holdings per sector, but they've got 4, or there's kind of, what do they call it, sector drift, or so just one, asking those the deeper questions, and that you don't have to use stop losses, but if you say you use them, prove that you do.
And I think, and another one is on that long short piece is, you can get authorizations to have a fund that allows you to go long and short, but do you actually use them? And the second piece is it purely for risk management, or are your short positions for alpha as well?
Yeah, and do you have experience shorting? I mean, shorting is a very different game to buying a stock and watching the earnings. You can lose more than 100% shorting.
And you can lose it quickly, right?
Yeah, exactly. So you can't there's a lot of people that pop up with a long short strategy that don't have the experience on the short side, which is very different.
Because this is I guess this is the catch-22 of having all these the different mandates and restrictions from a risk management perspective. It's good because you can sell, because you can go to a planning group and say, we only have this amount of weightings in this sector and blah 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 blah. But at the same time, if they are a good investor, you want to give them the freedom to invest well. So it's a bit of give and take, and you have to. That's where I feel like eyeballing the fund manager is really important. You have to understand their thought process as much as what they've written on the marketing document.